In this 2025 edition of the Ultimate Guide to Investing for Complete Beginners, I'll be sharing the top 5 best places to invest your money in right now in order to build wealth as quickly as possible. And unlike other videos, I'm actually going to show you where to invest your money and why. If you stay until the end, I'll also reveal my no. One best place to invest in 2025 that very few people know about. So make sure to save this video for yourself and don't forget it till next year. This is gonna be epic. Let's get started. Hello, my friends. My name is Anonymous. Hope you're doing well. If you're new here, welcome. I'm a qualified accountant and a professional investor with several successful companies. Sit back, relax, and enjoy this step-by-step guide which will teach you everything you need to know about investing. So whether you have $100 or $1 million, this video is going to help you make more money. Step 1. Choose an investment account. Now, before we get into where to invest your money, first you'll need somewhere to actually put your money. In order to invest, you'll need to open an account with an investment platform. When choosing a platform, there are 3 main things to consider. The first one is fees. You want to find a platform that doesn't charge any commissions when buying and selling stocks and ETFs. Secondly, you want to make sure that the platform is regulated because you want to know that your money is safe. And lastly, you want to make sure that the platform has the investments that you want to buy. For example, if you want to buy individual stocks or ETFs, then you'll need to make sure that the platform offers these investments. Most platforms offer both stocks and ETFs, but some only offer one or the other, so you want to make sure you choose the right one for you. Here are the top 3 best platforms to consider. Now there are 2 main types of investment accounts, a standard and a Roth IRA. A standard brokerage account is just a regular account that you can use to buy and sell investments. Anything you make in this account will be taxed at your income tax rate, which can range from 12 to 37%. A Roth IRA, on the other hand, is a special type of account that is designed specifically for retirement. Any money you make in a Roth IRA isn't taxed until you withdraw it, which is perfect for retirement when you'll likely be in a lower tax bracket. It is important to note that there are contribution limits for Roth IRA letters, so if you plan on contributing more than that, then you'll need to set up a standard brokerage account as well. But for most people, a Roth IRA is the best way to go because you won't have to pay taxes on your investment income. Step 2. Fund your investment account. Now that you have an account, the next step is to fund it. You can do this by linking your bank account or by transferring money directly from your paycheck. Once you've funded your account, you're ready to start investing. And as I mentioned earlier, there are 2 main types of investments, stocks and ETFs. Now let's talk about stocks. When you buy a stock, you're actually buying a small piece of ownership in a company. For example, if Apple stock is trading at $100 per share and you buy 1 share, you would technically own 1/16 of 1% of the company. Because of this, stock prices tend to fluctuate quite a bit throughout the day, sometimes multiple times per second. That means that if you buy a stock at $100 per share and the price drops to $90 per share, you would technically be down $10 per share. However, if the stock price increases to $110 per share, you would be up $10 per share. The key thing to keep in mind here is that when you buy a stock, you're betting on the future success of that company. If you think the company will be successful, then the stock price should increase over time. That means the longer you hold onto a stock, the more likely it is that you'll make money. But it's also worth keeping in mind that some stocks take longer to grow than others. For example, some companies might only start making money after 10 years of being in business. So if you buy their stock early on, you might not see any growth for a while. The next type of investment is an ETF. Unlike stocks, ETFs are made up of a bunch of different securities. For example, an ETF called VU is an S&P 500 ETF, which means it contains a small piece of ownership in all 500 companies in the index. ETFs are a great way to diversify your portfolio because they contain a wide variety of different investments. They're also often less risky than individual stocks because if one company does poorly, it won't affect the rest of the ETF as much. Just like stocks, the longer you hold onto an ETF, the more likely it is that you'll make money. But it's also worth keeping in mind that some ETFs take longer to grow than others. Step 3. Choose an investment strategy. There are 3 main investment strategies: active, passive, and semi-passive. Active investors spend a lot of time researching individual stocks and trying to beat the market. Passive investors, on the other hand, don't spend a lot of time researching individual stocks and instead just buy and hold a diversified portfolio of ETFs. Semi-passive investors fall somewhere in between the two. I personally use a semi-passive approach because it gives me the best of both worlds. I spend a little bit of time researching individual stocks and ETFs, but I mostly just buy and hold a diversified portfolio. Step 4. Decide how much risk you're willing to take. When it comes to investing, there is always some level of risk involved. You could lose some or all of your money, especially if you invest in individual stocks. That's why it's important to only invest money that you're willing to lose. If you're not comfortable with the level of risk involved, then you might want to stick with a low-risk investment like bonds. Bonds are loans that you make to governments or corporations. In exchange for lending them money, they'll pay you back with interest. Bonds are generally considered to be a low-risk investment because they're very stable and predictable. However, they also don't offer the potential for high returns like stocks do. Ultimately, the decision of how much risk to take is up to you. Step 5. Start investing. Now that you've chosen an investment strategy and decided how much risk you're willing to take, it's time to start investing. If you're using a platform, they'll have a bunch of different tools to help you out. For example, you can use their screener tool to find stocks and ETFs that meet your criteria. You can also use their watch list tool to keep track of the investments you're interested in. And lastly, you can use their news tool to stay up to date on the latest market news. As I mentioned earlier, I use a semi-passive approach when it comes to investing. Here's how I would invest $1,000 if I had it to start with. First, I would put $800 or 80% of my money into an S&P 500 ETF like VOO. This would give me exposure to the entire U.S. stock market and would be a great way to start building wealth. Next, I would put $100 or 10% of my money into a tech ETF like QQQ. Tech stocks have the potential for high returns, but they're also pretty volatile. So I think it makes sense to only allocate 10% of your money to them. Lastly, I would put $100 or 10% of my money into a bond fund like BND. This will help me sleep at night knowing that I have some of my money invested in something stable and predictable. Together, these three ETFs give me a nice mix of stability and potential for growth. I know. One best place to invest in 2025 that very few people know about is called the Dividend Channel. The Dividend Channel is a website that lists all the stocks in the S&P 500 that currently have the highest dividend yields. A dividend is basically a way for a company to give back to its shareholders. When a company makes a profit, they can choose to either reinvest that money back into the business or they can give some of it back to shareholders in the form of a dividend. Dividends are usually paid out in cash, but sometimes they can also be paid out in stock. The Dividend Channel is a great place to invest because these companies typically have a long history of paying dividends, and they also tend to be very stable and predictable. To see the full list of the top 10 best places to invest your money in 2025, check out the video linked above. That's it for today's video. If you enjoyed it, please hit the like button and subscribe. I'll see you in the next one.